Well, I'd like to add my welcome as well. Thank you so much. I'm Efrain Chavez, and as Dave mentioned, I'm the portfolio manager here at INCA Investment. I joined INCA in 2012 as a sector analyst, covering some basic materials, including cement, consumer product companies, and some of the airlines as well. Before I joined INCA, I spent 4 years at an emerging markets hedge fund in Connecticut as a Latin American specialist covering all sectors. Prior to that, I began my career in 2000 at Goldman Sachs as covering the retail names for Latin America, and then eventually I actually transitioned to do metals and mining for Latin America as well. Um, you know, One of the things that I want to highlight is that my whole career has really been dedicated to investing in Latin America, and that's really the common thread that you really see across the organization, as Dave mentions, and you see all our bios. It really is a dedication to investing in Latin America with experience of over 10 years on average for all of us, with direct investment experience in Latin America, which really allows for that flat organization that Dave mentions. Everybody has a significant voice in the process and the philosophy that we'll talk about through the next couple of days. I was born in Lima, Peru, and I was born and raised there. And I think it's a little serendipitous that I ended up at a firm called Inca Investments. My grandfather used to tell this funny story that you can trace our roots back to the Inca Empire. That was after a couple drinks, so I don't know if that's actually true, but nonetheless, it's certainly, I guess, serendipitous, if you will. But I'm certainly very excited to spend the next couple days discussing the portfolio, going through presentations of companies, having portfolio companies come and speak. This is really, for us, our fifth investment conference, and it really gives us a great opportunity to go through the details and have, I have the great pleasure of meeting with you often in your offices and going through and having a dialogue about the macro, the region, going to company specifics, talking about firm updates. And this is really a great opportunity to do that on an expanded basis in more detail over a 2-day period. So for us, it's quite exciting, and we really enjoy it, and I hope that we put on a good presentation for you. So welcome to Buenos Aires. As Fernando mentioned, we started planning for this conference 18 months ago, and as we made the decision because we thought it'd be a really exciting time to be in Buenos Aires on October of 2019. And I think we were right. I think that's very correct. Look, Argentina basically came back into the MSCI Latin America just June of this year. But we've had a long history investing in Argentina. This latest iteration of our investments in Argentina started in 2014 when we thought we became more certain that there would be a change in government that could lead to a change in policy. And we were right in that regard, where there was a new administration, the Macri administration, that came in, and they began to kind of reverse some of the policies that have been implemented by the previous Peronist and Kirchner administration that really had led to a significant imbalance in the economy of Argentina. So as we fast forward to today, many of you know that we are basically 12 days away from the election, a new election. And just a few weeks ago in June, there was a really big shift in consensus. It went from a potential re-election. It was a close, it's always been close that, there was a couple point spread between President Macri and the opposition, the Peronist opposition. But in June of this year, almost a couple weeks after they were admitted into the MSCI Latin America, it became very apparent because Argentina has a primary election, which has a very high turnout. Over 80% of the people actually vote in this primary election. And it became very clear that there would be a potential change now, once again, in administration, and now coming back to a Peronist administration with Alberto Fernandez as president. And on the ticket, it would be Cristina Kirchner, the same kind of polarizing figure that many people kind of attribute to some of the changes that happened previously that were really having the country head in the wrong direction. So now that's become consensus that it's likely that they will win in the first round. Now, that has led to a significant decline in prices for stocks in Argentina, as well as currency depreciation that has certainly taken, I think, the market by surprise. As all of you know, we certainly, as I mentioned, have had a long experience investing in Argentina. And this latest iteration, just this last year, we actually had decreased our exposure significantly, but we still had exposure. Now, we benefited throughout the year from the rise that we had seen in the share performance of companies like Galicia and Loma Negra. However, after this very steep decline that we saw just right after the June primary election, we actually have begun to actually increase slightly our exposure to Galicia. So as it stands today, we do have currently one position in Argentina, which is Galicia, which we're going to have, we're very excited to have management of Galicia come in and speak, and we'll have a very detailed discussion about what's currently going on. So with that backdrop around Argentina, I wanted to make sure that you guys understand that we were going to dedicate a certain portion of the agenda to Argentina. We'll do that by having an economist from BTG Pactual, who is the head of Argentine economics. He'll come and we'll have a very detailed discussion on the current environment. And in addition, we're going to have a political analyst that will give us an update on what's going on with the election and the prospects for the election. So this is in conjunction with what we'll talk about as a region, as we always do. As I go through my regional presentation, I just wanted to make a note that we are, you'll see in certain places we have aggregates of the region as a whole. That does not include Argentina, given Argentina still has data that is missing from 10-year periods that really don't make sense to make an apples-to-apples comparison. So we will kind of separate that to have a very detailed discussion on Argentina. And when I talk about the region as a whole, I'm talking about the major countries that we invest in, excluding Argentina. So let me kind of flip through and start talking about kind of the regional macro outlook. The table above, and just for your reference, we're on page 10 in your presentations, but Latin America's growth has been solid. It's certainly has grown over the last 10 years, has grown at a faster pace than what you see in the United States and in developed Europe. Now, this is definitely a moderation in growth relative to the growth rates that we were seeing in the early 2000s. And this is very clearly, Latin America is part of the global economy. There is no denying it. We have not decoupled or anything of that nature. It's really what you're seeing is the uncertainty, the global slowdown that you're seeing in general does hit Latin America. And one of the most important factors that we will discuss on a country-by-country basis in the region as a whole is that this uncertainty is certainly hitting confidence, particularly on the fixed investment side. And that is kind of an area that we will discuss that is really weighing down in the economic growth, which is actually being offset by the factor that we think is most important going forward, which is consumption. But what you see here is that you have a outperformance in terms of growth over the last 10 years. 2019, as I mentioned, is a year of slower growth. However, we believe there is an environment that exists in Latin America that is supportive of future growth. And that's what I want to go into the details of, to understand kind of where we are, the lessons that have been learned in the past, and how the environment looks for future growth going forward. So, oops. Okay. So I want to go through a couple factors that, for us, kind of signal the stability for that environment so that growth can continue on a path of kind of development. First, starting on the budget balance side. And this is, for us, just a very simple way to look at what governments are spending relative to the amount of revenue that they're taking in. And what you see here is that Latin America certainly has a very well contained budget deficit. Most countries have, below 4%, which we see the 4% tends to be the marker where it becomes more concerning that a negative feedback loop in the economy may start. The exception certainly is Brazil, where budget balances and budget deficits have been higher than the region as a whole. And this is really a consequence of the previous administration's overspending. Now, we're going to go into a lot more detail on Brazil specifically, but what it is important to note is that the current administration, the Bolsonaro administration, is making progress in trying to rein in some of this overspending by implementing reforms, which are really critical for the sustainability of the environment for Brazil. To us, one of the best ways to really measure the environment and the stability of the environment is to look at inflation. As you can see from the chart, over the last 10 years, this is the dark blue lines that you see here. The last 10 years, you've had very well anchored inflation numbers and actually improving. There's a significant improvement in Brazil, particularly as we're in the middle of 2019. Now, this is really important to note because when we have this low inflationary environment, what it's allowing these central banks to do is to lower interest rates to levels that we believe start setting the environment for fixed investments to actually come back. And you've seen them be very active in that regard to actually lower rates so that you can have the beginnings of that confidence to start investing once again. Many of us, as Dave mentioned in our bios, we live through periods of hyperinflation in Latin America. I myself remember living in Peru. And these are situations that we believe that not only the governments have learned from those lessons, but people have learned from those lessons, and the general populace. So I think there's more of a willingness for people to understand the measures that need to be implemented so that you do not go back to those hyperinflationary years that really become very destructive to the economies. So let's kind of shift our attention to more of the revenue side, right? This is, again, another measure of looking at how these governments are managing the amount of exports versus imports and their ability to generate revenues. What you see here is there has been pressure on the current accounts, given the decline in commodity prices that you're seeing globally. As I mentioned before, Latin America is not disjointed from the global economy, but I think it's important to mention that when you look at Latin America as a whole, only about 5% of their GDP comes from exports of commodities. I think that's a very the important number because there's a very ingrained mentality that Latin America is all about commodity exposure and commodity complex. For us, there are important companies within Latin America that do export commodities, but the actual development of Latin America and the ability for them to continue to grow at a sustainable path is really about consumption, and it's not about the commodity complex. Now, the two countries that you see have had an expanding current account, which is Colombia and Chile. Just to briefly talk about, Chile has about 14% of its GDP coming from exports of commodities, mostly copper, and I think it's important to highlight that it is a great effort that the government is trying to make to actually lower its exposure to those commodity exports by broadening its revenue base. And the same thing's happening in Colombia, where 8% of their 8% of the GDP comes from commodity exports, mainly oil, and the decline in oil prices has expanded that current account deficit that we're seeing. So, it's a situation where we see an expansion. We monitor it very closely. However, we think that they're well contained, and there are actions being made by governments and an understanding from the population, as I mentioned, that these imbalances need to be rectified to actually have a sustainable path of growth. Yes.
Does that 5% number include not just natural resource commodities, but agricultural commodities, or are they different?
So those are metals, mining, and agricultural commodities.
It's just 5%.
5% when you look at the GDP on a weighted average, right? The main contributor there would be Brazil, which actually has a very closed economy. In general, their exports to GDP are very low. It's closer to 1 to 2%. And please, if there are any questions, I want this to be as interactive as possible. Any questions at any point, please feel free to raise your hand. So let's shift over and talk about some of the balance sheet items, right? The way we want to look at a balance sheet for a country. And what you see here, as I mentioned in the past, there has been significant periods of distress in Latin America through the 80s, the 90s, starting in the 70s, actually, where you see LATAM in this light blue bar that had slightly higher actually public debt as a percentage of GDP. So government debt as a percentage of GDP at 53%, where the G20 economies in the United States were at 52 and 42. This really starts a period of debt becoming a big issue for Latin America, and certainly there have been periods where debt had to be restructured. However, those lessons that have been learned really forced LATAM, or Latin America, to start bringing down its debt to GDP, particularly on the public side, to levels where we see today in the 2010s at 38%. This is the average debt to GDP for the region, relative to you contrast that to what's happening in the US and G20, where you have a continuous increase in public debt to GDP. Now, the picture is also quite stark when you look at it when you include not only public debt, but you also look at the private debt side. And you see Latin American countries are certainly in this upper part of the graph, where you look at it on a relative basis when you include both private sector debt and public sector debt, and on the likes of the United States and Japan that have certainly increased their debt levels significantly, where Latin America has tried to contain it to a level that is that allows for an environment that can sustain growth into the future. Now, again, I'm not. My aim is not to say, well, Latin America is so much better than the regions below. It's really more about kind of setting the environment, setting the picture for what we see as an environment that's sustainable and can allow for future growth and the development of Latin America to continue. So let's drill down into some country specifics. The one country that did go into a pretty deep recession is Brazil. Now, the recession in Brazil was not a function of a financial crisis. It was not any banks going under. It wasn't an industry that had to be bailed out. It was economic mismanagement by the previous administrations that really wanted to bolster consumption through government-led subsidy programs. These programs really inflated a lot of consumption that was unsustainable. And once these programs had to be pulled back, it really led to a significant decline in economic activity. So that is really what begins and actually makes the 2015-2016 economic recession that you have in Brazil, one of the deepest that you've seen throughout the modern history here. Now as we fast forward to today, consumption and confidence is slowly coming back. I think a big part of this is as I mentioned in 2018, there was an election that brought in a new administration with Jair Bolsonaro becoming the new president of Brazil. And he has assembled, I would call, an economic team that has the understanding that these imbalances that I keep talking about needed to be addressed. There was no choice. And the reforms are being implemented to be able to stabilize that public spending that was potentially going to spiral out of control. So, if I look at what's happening thus far, just to give you an update, the first place that they tackled was pension reform. That was the biggest area of spending, so therefore they tackled that first. And pension reform has now passed the lower house. It's passed the first stage of the Senate, and now it's actually due to pass the second stage and final approval in the Senate by the end of this month. That will lead to approximately 750 billion reais in savings over the next 10 years. But I want to be clear about something, that this is not the silver bullet. This is a step in the right direction in order not to have the continued increases that you are having on the public on the fiscal deficit side. So there's still a lot of work to be done. And they are starting that work. There's already certainly lots of movement towards tax reform. There certainly has lots of movement towards privatization of companies that were run by the state, that were run very inefficiently, that they can really gather a lot of revenue that can come to the government, and actually can be productive to the economy as a whole, as you get new management of these companies that can be more productive going into the future. One of the things that, it's not just in Brazil, but overall in Latin America, for us, it's really important that Latin America continues to move towards a reduction in bureaucracy and allowing the ease of use for businesses to flourish. That it's really critical for us, and I think for the markets in general, that every day they make progress in trying to reduce those hurdles that make it very difficult, again, for new businesses to develop, for innovation to really come through. And we're starting to see that. We're starting to see in places like Brazil, where we'll talk about later about fintechs and how they developed, and in Mexico as well, in Peru and Colombia. But we want to make sure that those environments are creating the spirit of innovation that can really lead to future growth for Latin America. As I mentioned before, inflation, the government has done a very good job at anchoring inflation so that there's an environment that that allows for a substantial decrease in interest rates. Just in 2016, the Selic rate, which is the benchmark rate for Brazil, was at 14.25%. Last month, in the last cut that they made, they actually lowered it to 5.5%. That is a very substantial change, and it's having reverberations across the economy. I think that's a very good, a factor that, as I mentioned before, can lead to once again, the reignition of fixed investments, which I think are critical to the economy and to be able to offset some of the lower growth that you're seeing in other parts of the economy. Mexico. Mexico also had an election in 2018. It was a very busy political calendar in 2018, actually. In 2018, Mexico elects Andrés Manuel López Obrador. And many people just reduce it to AMLO as kind of an acronym. And, the first year of AMLO's administration can be characterized as rocky. Particularly when you look at it from kind of the investor sentiment and what you've seen investors be concerned with. So let me just kind of walk you through that a little bit, because for us, what we've observed so far is that AMLO has maintained what has historically been a kind of a staple of Mexican economic management, which is fiscal responsibility. And that is very well in line with the rhetoric that he espouses. He's very adverse to debt. And that's also in line with what we've seen out of his actions when he was mayor of Mexico City. Actually, Fernando lived in Mexico City while he was a mayor, and it's certainly the data points that we've seen are very consistent with the way that he was managing at that time versus now. However, the counter to that is that his philosophical leanings are certainly more towards having the government or the state be the solution to some of the inequalities that you see in the economy, the imbalances that you see in the economy, and some of the proposals that have been floated in terms of projects we find to be of a kind of questionable value. Thus far, those projects have really been met with resistance and pragmatism, which I think is really the reason why there is this push and pull from the market, where as maybe some of these projects get announced or floated out there, there tends to be a decline in the stock market. But when the pragmatism comes in, people realize, well, okay, well, it's really more about making sure that you're fiscally responsible, that you're not, kind of really disrupting the flow of the economy. Now, the economy has been hit, given that uncertainty that I talked about. In particular, one of the areas that you're seeing not only is on the fixed investment side, because companies are taking a wait-and-see approach. They're saying, okay, well, how is this going to play out? Do I really want to expand my factory? Do I want to expand my store? Do I want to hire more people? Until I have clarity on the policy direction for AMLO. And right now, it's been really more of a wait-and-see approach. And in addition, one of the areas that has been hardest hit is construction. And actually, Daniel Piderit will go through his sector presentation and talk about construction, because any transitions that you see in governments, and we've seen many of them, will have new people coming into new posts and have to manage new processes that can sometimes delay public works, commercial development, even residential developments. So that has been an area that has really hit the Mexican economy quite hard this year. However, on the other side, more on the external side, we see that Mexico is having some positive green shoots coming through. And some of this is related to what I would call more, let's call trade displacement. As you all are very well aware, there is a lot of uncertainty around global trade in general. And there is an often comparison that people want to make between China and Mexico. So how does China differ from Mexico when it comes to global trade? I think the clear distinction to us is that when you look at Mexico, it's really more of a supply chain partner to the United States. And we see that in that, if you look at the products that are manufactured in the United States, about over 30% of their content actually is made with parts that come from Mexico. That's not to mention the flow that goes. Sometimes they're assembled in one area, they're sent back for final, touches, and then they go back and forth between the border. This is in stark contrast in what you see in Mexico, which approximately 5% of the content that is manufactured in the U.S. is made with Chinese parts. So the distinction that you can be drawn there is that Mexico is a supply chain partner versus China that is more of a finished good exporter into the United States. So for us, it's really important to highlight that distinction, because as we are seeing the development of NAFTA 2.0 or USMCA, as they call it now, we think that's a really important step in order to give not only domestic companies but also international companies the visibility that they need in order to continue to invest in Mexico and develop their manufacturing capabilities, given the advantages that Mexico has. That, to us, is the long-term opportunity for Mexico. So let's walk through Chile, and this pains me to say as a Peruvian, but Chile is certainly the most institutionalized and advanced economy in Latin America. It has a very business-friendly administration that has reversed some of the higher, less friendly administration of the Bachelet for the last few years. They've continued to have an environment that is very supportive for businesses to develop, and for a broadening of the revenue base that will hopefully diminish some of the reliance that they have on exports. As we speak today, there is an ongoing debate in the legislature to try to implement tax reforms that will hopefully incentivize more domestic demand. However, this is a fine balance that many of these countries are facing. How do you go through and make sure that your revenue base is being expanded, at the same time not hurting the consumer or not hurting corporations by taxing them too much. As I mentioned before, Chile's most relevant export is copper, and that is certainly putting pressure on its external accounts. But we think that that's contained, and the progress is being made to reduce that the reliance on it. You know, Colombia's, particularly in the last 2 years, has been a real standout in terms of growth. Economic growth has come back with domestic demand really leading the way. Actually, retail sales were just released this morning, and retail sales year over year for last month were up almost over 9%. So you're seeing consumption actually increase significantly, and the Duque administration has made progress in, again, reducing the fiscal imbalance that they have, and at the same time implementing tax reform to try to broaden that revenue base. But also, I think it's also very important to highlight that the peace accord that was signed in 2016, just for a brief history, you know, the civil strife between the leftist guerrilla groups that of the FARC that had really plagued Colombia for more than 40 years, they finally reached a peace accord in 2016. We think this is a really important development, and while they're still, you know, hammering out some of the details of how to work through this agreement, we're cautiously optimistic that this will continue to yield positive benefits into the future as people feel, the general population feels more certain, and businesses feel more comfortable that they can operate their business without disruptions and civil strife, really, you know, kind of hampering their ability to grow the businesses. So now we come to Peru, which is, this is the highlight for me because it certainly experienced the best long-term economic growth over the last, particularly the last 10 years. You know, Peru has led growth through domestic consumption. And I want to highlight that because it certainly is from a low base. It has also benefited from an increase in its exports capabilities. Certainly there's been lots of mining expansions that have happened in copper and gold and zinc that have benefited the economy as things have transpired. But you've had a number of pragmatic administrations that have set the foundation for these businesses to develop and for consumption to continue to grow. And we see the environment continuing on that path. Now, I want to give you kind of a very brief update on, as you turn the newspapers today, there has been a what I would call kind of more political volatility. And this starts back to the election of President Kuczynski, who was elected in 2016. For some of you who may know of Kuczynski, he's certainly a very well-known figure in Latin American finance. Not only has he held many posts in Peruvian government, but he was also a private equity founder in a firm in Miami, actually. So when he returns to Peru to run for president and gets elected in 2016, as his term begins and starts to take hold, the Odebrecht scandal really starts taking roots into not only Brazil, but expands out to many countries in Latin America. The Odebrecht scandal, for those who may not be so familiar with it, is really is a Brazilian company that does public works and very big infrastructure projects across Latin America. Now, there has an investigation that begins and really expands throughout Latin America, where this company is found to be making bribes in order to secure some of these contracts with these big governments across Latin America. As the investigation starts closing in closer to a potential involvement by President Kuczynski, he decides to resign in 2018. Rather than to go through an impeachment process or anything of that nature, he decided, okay, well, it's time for me to kind of step down. And Vice President Martin Vizcarra comes into power, and he's a very different figure, if you will. He's more of a what I would call a technocrat, in a sense that, and he wants to make sure that that there's a continuation of improvements for the environment of Latin America, particularly on the legislative side, that will allow for the economic development of Peru to continue on a very good path. This is met with significant resistance by Congress, and they eventually come to a complete impasse. So nothing's getting done. Now, ultimately, what happens is that he basically says, look, I want to call for a vote of no confidence here, because this cannot continue. If we can't get anything done, a path forward becomes blocked. So the latest action that he's taken is really a complete dismissal of Congress, given there is no confidence in their ability to work together. And now this is going through a process of being challenged in courts. However, for us, it's important to note that this action is really supported by the population. And why do I say that? Is when you look at Martin Vizcarra's popularity and approval prior to the dismissal of Congress, his approval was at approximately 35%. After he takes this action, it actually jumps up to 75%. So the population understands that this complete impasse and this inability to get anything done needs to be resolved, and it needs to call for new elections. Now, you're already starting to talk about the election of Peru and what's going to happen. There are certainly candidates that have been from the past, new candidates that are arising, but what's important to highlight, this is an election that will happen in 2021. But there's still a long way to go. But for us, we continue to see Peru's economic development on a good path forward, and we don't see this as derailing its future path. So now we've gone through maybe some of the country specifics. I want to kind of circle back to that critical factor that I talked about, which is really consumption, and how consumption is really the factor that will lead growth in Latin America. So this chart here in really kind of exhibits the main driver of real GDP growth for all countries across Latin America. And you see that the light blue bars are really what we expect to have as a year-on-year growth in household consumption. Right? We see that there is actually ample room for this trend to continue, given kind of the growth in the middle class that you're experiencing and a very favorable demographic backdrop. Now, it's important to mention that Latin America, when you look at the percentage of GDP that comes from consumption, this is on average about 65%. This compares to the global average of about 58%. So Latin America is a region that is very consumption driven. And let's talk about some of those factors that are driving that. First, it's the expansion of the middle class. If you look over the last 10 years, there have been approximately 13 million households that have moved from poverty into the middle class. And we have now breached that 25% of households that are part of the middle class. To us, that's important because these are people who are now, for the first time, being able to consume products that maybe some of us take for granted, in the sense that furnishings in homes and even basic things like prepared foods and shampoos and things of that nature that really give a lot of opportunity for the companies in Latin America. There is a great presentation that's upcoming. I'm giving you the sneak peek that Jerónimo de Guzman will do on under-penetrated consumption in Latin America. We're really excited about that because, again, it goes really squarely into what we prefer and what we see in the economy as the biggest driver of growth. On the demographic side, as I mentioned, you see Latin America here at the bottom, where the median ages are below actually 35. So it expands from Peru to Chile, and what you see is a very stark difference relative to what you have in some of the more developed economies. This is important because the sweet spot of not only your earning power but also your consumption, your spending, really happens in your 30s and 40s. Why is that? This is the time when people are, have their jobs, are more secure, probably gotten promotions by this point, and now they're, getting married, having children, buying homes, furnishing those homes, trying to buy a car. These are all the things that go along with, that progression in terms of median age that really allows for consumption to be pushed forward. We think that the multinational companies have certainly taken note. And this is an analysis that we've done, and you may have seen this in the past, but these are multinational companies that have exposure to Latin America, but also have exposure outside. And what you see that through the period of from 2016 to 2018, their portion, the average growth that they've been able to experience in Latin America has been about 16%. This is compared to what you see in the world, excluding Latin America for these operations, that have grown about 10.6%. And Latin America is not an irrelevant portion of their business. If you look on average, it's about 14.6% of their businesses. So we believe that this this growth will continue to incentivize for investments to be made in Latin America, not only to feed domestic demand, but in certain cases to actually be part of their manufacturing hubs, like we talk about in Mexico. So this is a way that we see kind of the longer-term capital moving, if you will, how companies are making investments, where they see growth, and how they will continue to kind of fuel that growth based on consumption. Let me now move to a bit of a review of what's happened in terms of performance for Latin America. Despite the fact that Latin America certainly has bounced back from a bit from its kind of very low that it reached in late 2015, it's worth noting that Latin America is still down 29% versus the level that it reached in 2008. And just over the last 5 years, it's still down 17% for the levels that it reached actually in 2014. Now, this underperformance is certainly kind of noteworthy when you compare it to more on the relative basis, where you see this 29%, where Latin America is highlighted here, in very stark difference than what you see in the S&P 500 rise by 171%. It's also worth noting that some of the other indices that we mentioned here, this is the MSCI Asia, and this is MSCI Europe, which are still well above the levels that they reached in that same period of 2008. So this underperformance has really opened up kind of a valuation gap that is very large, and we wanted to highlight this and look at it versus the S&P 500. If you look 10 years ago, the S&P 500 and the MSCI Latin America were trading at similar price-to-book levels. You fast forward to today, and given the underperformance that you've seen, the S&P 500, the gap has opened up to the highest that we've seen over the last 10 years, with a 44% discount when you compare Latin America versus the S&P 500. To us, I think it's important to highlight that we see this as a relative opportunity, given what we see as the fundamental underpinnings that we see going forward for Latin America as a whole. Yes.
I know you say that's the largest discount in the last decade. How does that compare to sort of a longer history of your data? Is that the largest ever?
So, I've looked at it going back, and as far as we've looked back, it had 25 years of history. And there was one period that had a similar gap. However, I think within the 10 years, we're basically at that same level, that 44% gap, and it's closed back again. But then it's opened up again. So that's the only reference that we have going back to about 25 years. So, I want to now kind of just go through and kind of review some of the items that we discussed. As I mentioned through the beginning of my presentation, look, the Latin American economic environment has been improving. We think it's good, and we think that the improvements will continue, really starting in 2020. We think that the environment is such that as you have stability in the globe, we believe that Latin America is a place that will continue to be buttressed by growth in the domestic consumption side. It has underperformed, as I mentioned, on an absolute and relative basis. And this is despite the fact that earnings have continued to continue to grow. Actually, if you look over the last 3 years, EPS growth has been 19% annually over the last 3 years, which, to us, this is, again, it opens up the opportunity given the valuation that you're seeing on a relative and an absolute basis. So when you look at some of those metrics on an absolute basis, you see Latin America's trading at 11.9 times, and we actually see this is as somewhat weak growth. Well, I mean, weak earnings. We think there's a great opportunity for them to continue to grow, and this is below its historical average that we've seen at 12.6 times. And as I just mentioned, on a price-to-book basis, you have a 44% discount, with the price-to-book being at 1.9 times for the MSCI Latin America versus the S&P 500 at 3.4 times. I'm certainly happy to go through and go any of these items, or I'll discuss any items you want to talk about. Sure, Omar.
Can you discuss the pension dynamics between the countries and the prospects for a stronger local investor base, which would obviously, or could buttress, the hot foreign money coming in and out, which has defined the volatility
Sure.
For the region and EM broadly speaking, but if you can just discuss that within the confines of the region.
Sure. Yeah, there's certainly, for the region as a whole, there certainly has been a development for pensions to kind of broaden their investments more into equities, more in some specific items in some specific countries, kind of outside of the country in general. I think if we go country by country, I want to kind of highlight a couple of them, which, and starting with Chile, because I think that's a really important one. The Chilean pension system has traditionally been one that is very well developed and has been directed mostly to invest in companies locally within the Chilean market. This has historically led to higher valuations for the Chilean market, which to us has often led to less opportunities. We, as we'll go through and talk about, but we like to buy franchise companies at bargain prices, and you have these elevated kind of valuations. They tend to be more difficult to find. However, this transition has happened really over the last 3 years, where Chile has opened up their ability to invest abroad, and now you're finding more of a balance of that they feel comfortable in the balance that they've reached in terms of external exposure versus domestic exposure, and you have also had a underperformance in some of the Chilean stocks, which to us is their opportunities. These are the places that we want to continue to look at and turn every stone to make sure that, because we believe that Chile is a country that has the ability to sustain growth, so we'll be able to kind of get some more of those opportunities as the pension system has kind of worked this way. For Brazil, it is very much a confluence of different factors that are impacting there. Number one is certainly the environment that I mentioned in terms of interest rates is quite critical because, again, if many of these pensions and I believe investment managers in general saw Selic at 14.5 or 15 or sometimes higher and said, okay, I'm just going to move all my assets to, have Selic exposure. Now, with the decline of Selic to about 5.5, it really has incentivized more investment outside of Selic and into stocks. That I think that's a powerful force that can continue. In addition, what you're seeing is also a lowering of fees of trading activity for Brazilian stocks. Which I think is also an important factor that can, again, develop more that domestic individual or personal kind of trading that happens for these markets. Peru has a less developed pension system, and I think there's still work to be done there in order to continue that. But I think the region as a whole is moving in the direction of having a more open pension system that will allow for more flexibility. You know, the Afores in Mexico certainly play a big part in the ownership of domestic stocks in Mexico. Now they have kind of leeway to go outside of Mexico as well, but they certainly play a part, and we monitor very closely to see, okay, well, who are the holders? You know, when do we see opportunities? They tend to also, you know, be a large impact on lower liquidity stocks as well when some of these Afores take large positions into these smaller cap companies.
Answering this question will certainly involve speculation. Perhaps your educated guess or your team's educated guess is better than my uninformed one. Any thoughts on how the situation in Venezuela might pan out over time? I know it's not investable today. Some of us hope at some point, but
So, you know, I might actually call a lifeline here for a little bit because I know Fernando has done certainly a lot more. I can tell you my kind of educated guess is that it's a very uncertain situation, and it would be very much a guess that we believe, or I believe, that the current situation is unsustainable. So there is certainly a need for resolution, for change to actually happen. How long that takes, I think it's very difficult to call. We've seen kind of fits and starts where you could think, okay, well, potentially this is going to happen, but it gets, you know, it goes backwards once again. But if you don't mind, Fernando, maybe I can have you.
Sure. I took advantage of my Peruvian passport and went down to Venezuela. And I say Peruvian passport because right now with the U.S. passport, it's basically impossible to travel to Venezuela because you have a visa, and because of strained relations, you can't really get a visa as an American to travel to Venezuela. So I did it with my Peruvian passport. I was there about 4 months ago. You know, a lot of people are asking me, why in the heck are you going to Venezuela? It's really not a war zone at all. It's a fairly stable place that has demonstrations against the current administration. What I think is important about Venezuela, and Venezuela in itself is a very important economy within Latin America. Unfortunately, it's kind of fallen off the face of the investment map. I can remember going back into the mid-1990s when I was doing this. We had about 18% of our portfolio in Venezuela. So it was a pretty significant market. But with the Chavez administration, and particularly the companies that were the big listed companies had been basically expropriated or have really just diminished in their business capacity, and now we have basically a non-existent stock market as far as volume goes, but there's a lot of companies that are trading. Purpose of my trip to Venezuela was to see, hey, I always like to see things from the ground and meet with the brokers and meet with the investment community that some of them would have a very long relationship with to see what was going on. And to me, it's highly unpredictable politically what is going to happen in Venezuela. It certainly doesn't appear to be sustainable if you think about government transitions and changes like that. You can put a very close correlation to hyperinflation. Hyperinflation is a killer if you want to stay in power. And that's what the situation is. He certainly wouldn't win a fair election. So it's an autocratic government that is trying to maintain in power, but it's very difficult when your economic situation gets so rough. So I certainly don't have any predictions as to what's going to happen there in Venezuela. My guess would be that it's unsustainable. You're going to have a change. And at that time, what's going to happen in particular with the banks and a lot of companies, they're going to have to recapitalize. We think there's going to be an investment opportunity there. Some of them may be listed. Some of them are not going to be listed. So we think that's a very important potential opportunity maybe sometime in the future. Where you're having a direct impact right now is Colombia. If you think about, you have had 4 million refugees. So give that a little bit of context. Syria, which gets a lot of headlines, has 5.4 million refugees. So 4 million refugees that have left Venezuela, the vast majority of them into Colombia, it's quite a burden. It's been a burden, and one thing that should note, and this tells you a little bit about Latin America as a region, because we're not a tribal area. We have relatively same religions and same language. You don't hear the kind of same sort of kind of problematic situation that you've seen where certain countries are trying to stop the immigrants and some from coming in. Colombia, certainly it's put a strain on them. Certainly there are a lot of people that are complaining about having people living on the streets that are homeless from Venezuela. But overall, I think they've been pretty gracious hosts, as well as countries like Ecuador and Peru also that have taken a big chunk of the immigrants. So, but it is a big negative factor for Colombia. Colombia will benefit greatly from that when this situation stabilizes. The other thing, when it comes down to us with our portfolios, we have companies, whether it be Copa or Arcos Dorados, that had very significant revenues from Venezuela, which has become a negative, sometimes a neutral, but that's going to create some potential for them to take benefit of a stabilized Venezuelan environment.
Yeah, if I could add to that, just as Fernando mentioned, there are multiple companies within the portfolio that have had exposure to Venezuela and have a long history and are ready to, they call it almost a call option, right? Where right now they're not really spending in Venezuela, they're just keeping operations, so they have the optionality. But this would include Arcos Dorados and Coca FEMSA and Copa, that we think that once the economy stabilizes, hopefully someday in the future, that could be a great opportunity for these companies. Yes.
When Venezuela is functioning, and so
Sure.
About 5 to 10 years, how important was it on the economies of Brazil and Colombia and Ecuador, or is it more of a import-export to the West kind of market?
No, certainly, particularly for Colombia, it was its largest trading partner. So it certainly made the economy of Venezuela, as Fernando mentioned, was certainly a significant portion of Latin America in general, and certainly there was lots of trading between the countries, and that has certainly put a lot of pressure, in particular, like as I mentioned, Colombia, Peru, those factors coming back could be a positive kind of tailwind that could help the economies into the future. But at this point, this has been lowered by so much that it's not really showing up in the numbers. Yes.
I mean, it seems income inequality across the region is still obviously a major issue, which is sort of causing the lean to some of the left-leaning and populist parties. I mean, how do you see that dynamic playing out on the investment outlook in the sort of medium to long term?
Yeah, no, I think that's a critical factor that needs to be addressed, not only in Latin America, but I think in general in many countries, even to a large degree also in developed markets as well. However, I think for Latin America, I think there's a clear understanding that it's a benefit for any administration, left or right, that needs to have financial inclusion be a part of their administrative targets. What we've seen in many countries, in Peru, Brazil, Mexico, as examples, where there's a difference between, I think, some of the rhetoric that you may hear from a way of getting elected relative to the actions that these governments take in order to try to stay somewhat in the middle and have the ability to try to improve those 13 million homes over the last 10 years that have moved into middle income. That's a process that can lead to continued growth and stability, and I think the governments realize this, that they need to continue to do that. It really varies by country, but I don't see at this point, I think the one area that we're going to be discussing in greater detail where that's going to become a very hot button issue will be Argentina. Because what you have now is a significant shift, right, from a very more right of center administration to now a left of center administration in a population that is really has become tired of the high inflation, the depreciating currency, the fact that they now feel that they have less than they had under previous administrations, right? Where these government programs are really handing out consumption to them, and that's what they remember relative to the harder times that they're facing now, but. It's a fine balance that needs to be measured by the governments, but at the same time, when you look at it on a company-specific basis, this is something that for us is really critical. As we said, consumption to us is the driving factor for GDP growth in Latin America, and the more basic for us, the better. The more the ability for those products to get into households that are just, the very first things that you think about as quote unquote like staple or luxury items, meaning the ability to go out for a McDonald's or the ability to have a prepared food in Brazil from Sadia or BRF. Those are the items that we think that as more financial inclusion happens, those companies continue to benefit from that growth that we're seeing in the middle class.